Hello again. Welcome to Consideration Before Investing. My name is Young Mao. I will be your learning partner and guide throughout this presentation. This presentation will cover things to consider before you start investing, such as getting your finances in order, creating an investment plan, setting investment goals, and understanding your risk tolerance. At the end of the presentation, I will provide some reminders on what to do after you view this presentation. There are many benefits to investing. One major benefit is the ability to utilize the time value of money to make your money grow over time. Another benefit are the tax shelters that investors qualify for when they invest. I will talk more about investing and taxes in another presentation. However, before you jump onto the investing wagon, it is important to take a moment to establish an essential financial foundation. So ask yourself, how are you doing financially? Do you have a budget or spending plan? Do you live within your means? Do you have any credit cards debt? Some credit card companies charge high interest rate that cannot be matched through conventional investing methods. For example, if you are paying 14% interest on a credit card debt and you only get 8% return on your investment, you're actually going backwards. So if you have credit card debt, it is advised that you use your money to pay off or dramatically reduce your credit card balance before you start investing. A second important question to consider is whether or not you have money left at the end of each month to dedicate to investing. For the most part, investing requires that you commit your money towards something long term. That means that you will most likely not have access to the dollar that you put towards your investment for a while. In emergency cases, you can draw money from your investment account, but you might have to pay a fee for doing so. To help you get a better idea of your financial health, we have created a few interactive worksheets, such as cash flow statement, spending log, net worth, and so forth that you could use to conduct your financial health checkup. In addition to understanding your financial health, it is important to have an emergency fund before you start setting money aside for investing. For a more detailed discussion on emergency funds and how much to set aside, please go back and review the financial planning process presentation. Insurance is another important item to consider before you start investing. Having adequate insurance is important to your financial well-being. Sometimes accidents or illness happen, and having adequate insurance will shield individuals and family from going into a financial crisis. So before you start investing, take a moment to evaluate if you have adequate health insurance, auto insurance, life insurance, and other important insurances such as disability, home, and the like. Last but certainly not least, it is also important to create an investment plan. An investment plan will be invaluable in guiding you through your investment journey. When developing an investment plan, consider short-term goals, like saving for a car, intermediate-term goals, like saving for a down payment on a home, and long-term goals, like saving for retirement. Again, please refer back to the financial planning process presentation for a discussion on goals and the best practice on setting goals. Okay, so what else is helpful to consider when creating an investment plan? Well, in the last slide, we mentioned time, like short, intermediate, or long-term, and purpose and needs, like saving for a car, down payment for a home, or retirement. Other considerations that are helpful include allocation and risk. For allocation, think about how much money you would like to set aside for investment purposes. Keep in mind that when you set money aside for investing, you are committing that money to an investment product or vehicle for a given amount of time. Withdrawal of funds before an agreed upon time will often result in fee. For example, if you put money in a traditional IRA to invest for retirement, you have to keep your money there until you are 59.5 years old, or 59.5 years old. Withdrawal before that time will most likely result in a fee charge. There are exceptions though. We will talk more about IRAs and other retirement investment vehicles in another presentation. Lastly, consider your risk tolerance before you invest. Your risk tolerance will influence which investment products you'll be comfortable purchasing. The last thing you want to do when you start investing is to stay up late at night worrying about your investment. We will cover risk tolerance in another presentation, and you will have an opportunity to take an assessment to evaluate your risk tolerant level. Okay, so what is risk tolerance anyway? Risk tolerance is your ability to take more risk in exchange for the possibility of higher returns. In the world of investing, there are products that are riskier than others. Riskier products have the potential to yield a high return. However, they also have a higher probability of collapsing and losing much, if not all, of their values. This translates to you losing money. Lower risk investment products have a low probability of collapsing, but will also have lower potential yield. We will cover risk tolerance in more details in another presentation. Thank you for joining me for this presentation on consideration before investing. If you haven't done so, please take a moment to come up with a few investment goals.